Good afternoon. My name is Ross Marcellin. I'm the Director of the Plan Compliance Department in the Office of Negotiations and Restructuring at the PBGC. Before we start, I wanted to go over a few housekeeping rules. Please be aware that today's webinar is being recorded. The recording and slides will be available on pbgc.gov at a later date. Due to the amount of material that will be covered today, we will not be able to address your questions. However, later on in the presentation, we will provide information on how to submit your questions, in addition to how to submit comments about the interim final rule. Today's topics will focus on PBGC's application process, assumptions, guidance, and available resources for plan practitioners as they relate to the Special Financial Assistance Program, also referred to as SFA. I'm joined today by Julie Cameron at PBGC, a supervisory actuary in the Office of Negotiations and Restructuring's Actuarial Department, and Harlan Weller, government actuary from the United States Department of the Treasury. Here's a list of items we will cover today. A review of our first webinar, PBGC's ARP/SFA homepage and resources, e-filing portal walkthrough. We'll walk through the website used to submit applications for special financial assistance. We'll walk through an actual application, many of the templates and checklists involved there, communications post-submission, and Treasury guidance related to reinstatements and makeup payments. We'll begin with a recap of our first webinar. Our first webinar is currently available at the links you see on your screen. At pbgc.gov, the ARP Special Financial Assistance homepage, you will be able to navigate to a recording of the video, as well as the slides available for download via PDF. The topics that were covered there include an overview of the Special Financial Assistance Program and the interim final rule, the application and review process, as well as how priority plans will be handled, a little bit of detail with respect to the restrictions, conditions, and the reporting requirements that will apply to plans that receive special financial assistance, and information about PBGC guidance and resources available. A little bit of a recap on the conditions that will apply to plans that receive special financial assistance. ARP grants PBGC the authority to impose reasonable conditions on plans that receive special financial assistance related to the following areas: increases in future accruals and any retroactive benefit improvements, the allocation of plan assets, reductions in employer contribution rates, diversions of contributions, withdrawal liability. Also important to note that plans that receive special financial assistance are actually required to amend plan documents to include a provision obligating the plan sponsor to follow the terms and conditions of ARP and the Special Financial Assistance Rule. However, PBGC is prohibited from imposing conditions related to prospective reductions in plan benefits, plan governance, and any funding rules related to plans that receive special financial assistance. With respect to certain events, such as mergers, transfers, and spinoffs, the amount of special financial assistance is limited to the amount determined as if the given event had not occurred. So if a merger, transfer, or spinoff might result in a situation where a plan might think that they are entitled to more special financial assistance than they would have received without that transaction, the amount of special financial assistance the plan is entitled to will be determined without regard to that, again, that merger, that transfer, that spinoff. And again, the conditions are covered in much more detail in that first webinar. We encourage you to go back and review that if you weren't available for the first one. Next, we'll talk about the ARP/SFA homepage and resources available. The interim final rule was published in the Federal Register on July 12, 2021. The 30-day comment period began on that date. Additional resources are available again at pbgc.gov/ARP-SFA. There you'll find some frequently asked questions. You'll find recorded informational sessions, the first webinar I've been referring to, and you'll also be able to register for email distributions to receive updates and information. The date of the final rule being issued is to be determined. On the left-hand side of this slide, you'll see a screenshot of our homepage. That bright green box indicates that we are open for applications right now. The application status for applications for special financial assistance, again, is open right now. We are currently only open to plans in priority group 1, and that is plans that are already insolvent or projected to become insolvent before March 11, 2022. Again, more detail around how the priority group plans works is available on that first webinar, which you can access via this page. There's also links on this page that you'll find to instructions, templates, and other resources. You'll find links to the e-filing portal, which we'll be walking through in just a moment. The status of submitted applications will be available on this page, any other important updates, and the link for you to sign up for the mailing list. Next, we'll walk through the e-filing portal. So some of you who are practitioners for multi-employer plans might be familiar with PBGC's e-filing portal. The link is available at the top, efilingportal.pbgc.gov. When you go to that website, you'll see what you see on the left-hand side of this page here. You'll see a welcome to PBGC's e-filing portal. From here, there will be a number of filings available to applicants. You'll see 4010 filings, reportable events, settlements, and requirements, but what you will be looking for is the multi-employer filing session. I also want to point out that the instructions are also available by link at PBGC's e-filing portal. At the bottom of the web page, there will be you'll have the ability to enter in your user ID and password. If you already have one, you'll just enter that and log in. If not, you'll click the link to apply for a new account, and we'll walk you through that intuitive process of creating an account. Once you've signed in, it will take you to this screen here. This is the screen where you'll select the filing type you're interested in. And what you'll be looking for here is to create a new ME filing, a new multi-employer filing, and that's what's highlighted in yellow there, right next to multi-employer events, filing drafts. After you've selected the multi-employer events, it will bring you to this screen. This is for you to select the filing type and create a new filing. And what you'll be looking for here is under financial assistance, you'll see three options for application for financial assistance. The first is initial, the second is recurring. What you will be looking for is the application for financial assistance special. So you'll select that button and then click next. This will take you to the basic information screen. All of these fields are required. You'll be required to enter in the name of the plan, the EIN and PN, the name of the notice filer, and the role of the filer, whether an actuary, an attorney, the relationship you have with the plan, as well as, probably most importantly, the total amount of special financial assistance that is being requested with the application. After you've entered in all this information accurately, you'll click Save and Next. This will take you to the document uploading page. This is where you will upload all of the documents associated with your application for special financial assistance. You'll select the file, choose File. That will bring you to a drop-down where you'll be able to select files from your computer. Once you've selected a file you'd like to upload, and it does accept various types of documents via PDF, or it's a Word document, an Excel file, those are all fine. It will actually ask you to select the document type. There are 17 document types associated with an application for special financial assistance. And the way the system works is that it will expect you to associate a document with all 17 of these document types. You might find that you don't need to attach a document for one type or another, or there might be a combination of different documents in one document you've uploaded. If that's the case, we ask that you simply enter some comments into that box above to explain why any of the documents below don't have a document attached with them, and that will actually be required for you to enter something into that comment box for you to proceed. But once you're satisfied that you have selected all of the documents necessary for your complete application for special financial assistance, you'll scroll to the bottom and move on to the next screen. And that will take you here. Here it will tell you that you have indicated that you wish to submit an event filing to PBGC for the plan, and it will give you the plan name that you entered earlier on. And it will just check, this is a confirmation that you do intend to submit button. Once you click submit here, you will not be able to revise what you filed. So it's important that you review the documents that you've attached, that you ensure that everything required for a complete application, as per our instructions, as per the checklist, has been attached on that prior screen. When you're satisfied that you have done that, you will click submit. On all of these screens, you'll have the opportunity to click the help button. And if you decide that you do need some help and you click that button, it will take you to a screen that looks like this. Here, it will say if you need any further assistance, it will give you the multi-employer program at pbgc.gov where you can submit questions. It will also give you a phone number that you can call. Next, we'll turn to the application walkthrough, and I'll hand it over to my colleague, Julie.
Thank you, Ross. Hi, my name is Julie. Hello, everyone. I will be walking you through the application materials, the different documents and tools that you need in order to complete an SFA application. Ross talked about the different, how you upload it to the portal, and now we're going to review the actual application items. And as you can see, we've got 4 blocks here. We've got your summer reading list. I bet you've already started. I bet you read your statute and your regs, which is great. And then there's the assumption guidance, which provides guidelines for changes to certain assumptions. Then we have the application instructions and checklist. These help set the requirements for the multi-employer plan filing an application. And then we have the application templates, which are Excel-based files to aid providing certain information required in the application. And as Ross noted, all of these things are on PBGC's SFA ARP page, webpage, and that was on slide 7. Okay, so is there an assumption change? What are we talking about? The statute had referred to assumptions in your certification of plan status completed before January 1, 2021 as given it the thumbs up. These assumptions are okay. And throughout the presentation, I will refer to these as the original assumptions. And I will also refer to that particular zone status certification as the pre-2021 zone certification. So when you decide and you are filling out your application and you're trying to determine your SFA amount, you have to determine, do you have an assumption change that is different than those original assumptions in the pre-2021 zone cert? So either if you do, section 4262.5 tells you the information you need to submit to PBGC when you have an assumption change. You have to describe why the original assumption is no longer reasonable. You have to propose a different assumption and why the new different assumption is reasonable, and you have supporting rationale that goes with that in documentation, which could be an experience study. There are examples of supporting documentation in section D of our instructions, the large instruction file. And once you determine if you have an assumption change, you have the information, you can supplement this with the assumptions guidance, which talks about acceptable assumptions. It talks about generally acceptable and generally not acceptable. And then there's discussions about CBUs, contribution-based units, administrative expense assumptions, mortality, contribution rates, new entrants, and investment expenses. The assumptions guidance is not required, but it is a very helpful resource. Assumption changes. Well, generally zones certifications do not utilize assumptions for 30 years. There may be 1 or 2 out there, but if you have, for example, a plan that is projecting insolvency within, let's say, 8 years, then the assumptions in the zone certification are not being utilized post-insolvency. So you may think, well, I'm going to just use my original assumption I had in my pre-2021 zone cert, because for some, the CBU assumption isn't lasting past this 8-year projection period, and I need a new assumption or another assumption for this 30-year projection that I'm doing for the SFA. Well, using your old assumption and just extending it, we consider a change of assumptions. So change, which means you have to provide all the information in 4262.5C, and that's all, again, uploaded in sections D of our instructions. In our guidance, there are certain acceptable, referred to as acceptable changes or extensions to certain assumptions. And so if the plan is using any of those, then there is minimal rationale that needs to be specified for those kinds of assumption changes. Our guidance also refers to generally acceptable assumption changes, and this is inside in the guidance itself. It talks about example changes for the CBU, or if you're changing to a mortality table, that's a modified PRI 2012 blue collar table. It also talks about any significant events in plan data that's changed from the valuation data that you are using, and what adjustments you can make. So there's generally, you still have to provide all the rationale but for these generally accepted assumptions, we're more likely to look at those, and those won't be as scrutinized as something that is not in the acceptable or not in the generally acceptable. You can still come up with an assumption that you believe is truly reasonable for your particular plan, as long as you provide the information, you provide the detailed supporting rationale for that. There shouldn't be a problem. There is a section, though, in our guidance that talks about not generally acceptable. And it's things such as speculation on industry transformations that you're trying to incorporate in your CBU assumption. And there's also some comments about investment expenses. So there's 3 buckets there. And there's kind of this other, which as long as you provide the rationale and it makes sense and it looks reasonable, you shouldn't have an issue. And moving on to the instructions, there are 5 sections, but there's also additional addendums depending on the situation. Ross had talked about some special events about mergers and transfers. And so that I'm not going to go over today. We're just going to go over the basic 5 sections, but they are out there. So section A, Ross has already gone over. That was in slide 10, very minimal amount of information, just basic name, EIN PIN, filer name, role in the SFA requested amount. Section B is all about plan type documents. So there's plan documentation. You can have your plan doc, you can have amendments, valuation reports, Form 5500s, zone certifications, it's here on the list. There's a lot of information you have to upload to the portal from section B. And Ross had mentioned about docs. Well, in the checklist, which we will get to, it actually says what document type to use for each item that you need to include in your application. So we will talk about that soon. Section C is all about plan data. These are the templates. There are 8 templates, and they're really there, like I said earlier, they're Excel-based files. They're really there to aid in the information that's provided in the application, and we will talk about those in the following few slides. 4th section, section D, it's a pretty big section. This is where you provide all that detailed supporting rationale for all assumption changes. Also, you have a narrative description of your projected future contributions and withdrawal liability payments, and a narrative on how you intend to reinstate benefits for certain participants in plans that have had experienced suspension of benefits. That includes insolvencies and MEPRA approved applications. And that's just for those particular plans. And the big thing is here in section D is identifying the eligibility criteria that the plan satisfies that makes it eligible for this particular program. In addition, you have to identify what priority group you're in, assuming we're during this initial year period where we have priority groups. After that, it's no longer applicable. There's also reconciling your fair market value of assets to your SFA measurement date. And SFA measurement date is the quarter ending before you submit your SFA application. So for example, if you submit your SFA application on September 15th, your SFA measurement date is going to be June 30. Section E is the checklist, which we'll look at in a minute. And then there's certifications from the plans enrolled actuary. You must certify and obviously follow all the ESOPs, the SFA amount that's been determined, the eligibility criteria that you identified in section D, and the priority group that you identified in section D. In addition, the plan sponsor must certify the accuracy of the amount of the fair market value of assets of the SFA as of the SFA measurement date. This must reference and include information that substantiates the asset value, such as a trust or account statement, and any projection of the assets from the SFA measurement date. All right, now we have our handy dandy list of the templates. So there's a summary. All of the templates are Excel-based. All of them include basic plan information in the upper left-hand corner of every template. So that would just be your abbreviated plan name, your EIN and PIN. And we ask that when you do use an abbreviated plan name, you keep the same one throughout the entire application. That way no one gets confused. So there's the checklist. And it's got a lot of items, but what's helpful about it is it includes file naming conventions that you can use. And certainly, like we mentioned before, what kind of document type is this that you're uploading? And it's required for every single application. You must upload the checklist. Template 1 is just projected benefits from your 5,500 for plan years 2018 until the last plan year before you submit your application. Now, this is only applicable if you have 500 plus participants. That's just the rules in the 5,500, and so we're following that. Template 2 is the top contributing employers and the amounts that they contribute. And it doesn't matter if this is a 1% contributing employer, 2%, has nothing to do with the Schedule R in that regard. Now, this is only for plans with participants of 10,000 participants or more. So we're not expecting a whole lot of these. We're expecting a whole lot of template 1. We're not expecting a whole lot of template 2. Template 3 is required, and it is your historical contributions for the past 10 plan years. These 3 are fairly self-explanatory. You may have downloaded these templates already, and if you're scrolling through them, you can see they're pretty self-evident on what you need to do. The next few templates are the more difficult ones that we'll explain later on. So the SFA template 4. So a lot of times I'm just going to refer to template 4 or the SFA calc, but I try to use them. I use them interchangeably, but I really want to keep using the word template 4 because I think it helps define where we are. So template 4 has the SFA amount you requested. It shows the data and the backup for that information. It has cash flows that reflect the SFA amount, it has present values, and every plan must submit a template 4. Template 5, which is very similar to template 4, is a demonstration of an SFA amount under baseline assumptions, and we will talk about those in a few slides. And then template 6, 4, 5, and 6 are interrelated. So template 6 is a reconciliation between the assumptions used in template 4 and template 5. And if it happens that template 5 is exactly like template 4, well, then you don't need template 5 or 6. Template 7 is really an identification of assumption changes from your pre-2021 zone certification, your original assumptions, compared to those that you use to become eligible for SFA program, and those used in your SFA calculation that's shown in template 4. And then template 8 is really just a detailed projection of your employer contributions and withdrawal liability of payments that are being assumed in your template 4 cash flow projections. Okay. Now this is an image of the SFA checklist. I know it's a crowded slide. It doesn't satisfy any of the rules of what should be shown, but the reason we're showing it is to say, hey, this is what the Excel file looks like. And here's up here in the left-hand corner, like I mentioned before, that we have our basic plan information up in the upper left. The checklist is designed to help, I would call them the application prep team, to make sure that you have every item accounted for that needs to be uploaded in the portal and part of the application. It identifies a naming convention, and it tell us what you've named the file. It also tells us, we've given you a requested naming convention, and then, sorry, I just said that. It also tells you what document type to upload the items under. So these are a few items. This is not all of the items, obviously, in the checklist. There's probably 80 or more items. But if you look at number 1, which I guess if you can tell, that's row 13. It's the first row in this little list here. And it says, do you have your application checklist? You better answer yes, because everybody has to have one. And then it has a sample name, which would be checklist sample plan dot extension. The next column talks about a reference page number. In this particular case, you don't have one because it's a single file, and that's the plan comment, just a single file. But over to the right, you can see that all of the items have a regulation reference and an instruction reference. So you can see that you're covering all these different pieces. Items 2, 3, and 6, which are the next 3 rows, the reason we're showing these is because all of this information for each item was uploaded in one document, special financial assistance application sample plan.pdf. So it's all in one document. And so the reference number is important here because you can tell us that item 2 is on page 1 and item 3 is on page 2 and item 6 was on page 3. So you need to identify where these things are. And that's really what it is. And that's there to help you guys in your application prep. Template 4. So originally I had said that template 1, 2, and 3 were pretty obvious. And so we're not going to do screenshots of those. We're going to move right into the heart of the application, which is template 4. There are 4 worksheets in template 4. There is the instruction sheet. There's your SFA interest sheet. There's a benefit payment sheet. And then of course, there's the big details cash flow on the 4th sheet. The first sheet, or I'm sorry, the second one with the interest rate, all you're going to do is you're going to plug in what you say your SFA interest rate is. And it's just a documentation of the pieces on how you develop that particular interest rate. So it's your, you enter in your interest rate you use in your pre-2021 zone certification, for funding standard account purposes. And then you will also enter in what is commonly known as the 3rd segment rate. And actually in the template, there is a link to those segment rates. And then it adds 200 basis points. It takes the minimum and it says, yes, we match you, or no, we don't. And if it doesn't, then I would obviously look and make sure you've got the right interest rate. You certainly don't do all this work and not have the right interest rate. On the next sheet about the benefit payments, that's just breaking it down by participant status. So the benefit payments that you're using in your main cash flow for your SFA amount, this is just breaking it down by retiree, beneficiary, by terminated vested, by actives, and new entrants. And in this sheet, also with the benefit payments, and this is the way it works for all of where you are providing benefit payment streams or cash flow streams, there will be a present value of all these items. And so the last sheet, which those benefit payments feed into this last sheet. The last sheet is all about your deterministic cash flow projections through 2051. And then of course the present values that go with each of those columns in your cash flow that's in this 4th sheet of template 4. And we've got a picture of that. But before we do that, let's look at the present values. All right, so now here's a snapshot of that last sheet in template 4. This is where those present values that we just went over, those are outlined up above in the top chart. And then the cash flows that go with all those present values are in the 2nd chart. And of course, if I tried to squeeze all of it on here, you wouldn't be able to read any of it. So I hope that this is somewhat legible. The one thing I want to point out is that if you look at number 8, the administrative expenses, in parentheses, it says excluding amount owed PBGC under 4261. So for all those plans that went insolvent and there's the loan from PBGC, you are not putting that in the spreadsheet. That is dealt with outside the spreadsheet. So I just wanted to point that out. But again, this is just a cash flow all the way through 2051 and the present values that go with them. All right, hang in there. We're halfway through. I'm just kidding. The next set of information is, we want to make it clear that templates 5, 6, and 7 are there to support PBGC's review of changed assumptions. This information in these templates, it identifies assumption changes, it will quantify assumption changes, and it summarizes the rationale. The actual detailed rationale is what is uploaded or just talked about in section D of the instructions. Okay. Template 5, the baseline. So we talked about template 4, that's showing your SFA amount. In this case, we got about 122 million. Template 5 is very similar to template 4. You have to show us your projected benefit payments broken out by status. You're going to show us the cash flows associated with the baseline projection and the present values of those. So that you open up the 2 templates, they look virtually the same. And of course, in template 5, once you figure out your SFA interest rate, that's just set in stone. The baseline assumptions, what are those? I like to think of them as the pre-2021 zone cert assumptions, your original assumptions, plus acceptable extensions or acceptable assumptions from section 3 of our assumptions guidelines. So if a plan chose to change an assumption to something that is acceptable from our guidelines, then that goes into template 5. If it's in template 4 and it's acceptable, it's in template 5 and it's acceptable. If the plan proposes a CBU assumption or an administrative expense assumption that does not fit into the acceptable extensions from our guidance, in template 5 for the baseline, you must use the acceptable extensions that is in the guidelines. So why don't we look at the next page for a little example so you can see kind of a summary, and then hopefully this will help clarify what I've been talking about. All right, so we got a chart here, got 4 columns. We've got the assumptions on one column. The next column are your original assumptions from your pre-2021 zone certification. Column next to it, SFA calculation. These are the assumptions you're using in your template 4 in your SFA calculation. And then the last column is the assumptions you're using in the baseline for template 5. So mortality. Let's assume that the plan was using, and as an original assumption, the ARP 2014 with a projection scale AA. The plan decides that it is more reasonable, more appropriate to be using the PRI 2012 blue collar mortality table with the recent projection scale. Well, for the baseline, you're going to use the same thing you did in template 4 in this particular case. If the plan had decided we're not changing our mortality, we're just sticking with RP 2014, then that would be for template 4 and template 5. That's an original assumption. If you look at CBUs, the contribution base unit assumption, the original zone certification has a 3% decline. And for template 4, the plan decided we're going to use our 3% decline and we're going to extend it using the acceptable extension noted in the guidance. And by the way, the guidance does have many examples that makes it very clear how to calculate these things. And in template 5, you would use the same acceptable assumption extension. So here, again, we really don't have a difference between template 4 and template 5. We look at the administrative expense assumption. The plans assumed a level assumption, so in their as an original, so basically a 0% increase. The plan decides that it is more reasonable and has demonstrated through the detailed supporting rationale that 2% per year increase is what it's going to use. For template 5, that 2% increase is not under the acceptable changes. That doesn't mean it's not okay, but for the baseline purposes, you will use the acceptable extension instead. Retirement rates. The retirement rates used in the pre-2021 zone certification are referenced in the 2019 valuation report. That often happens with zone certifications. You reference all other assumptions not stated are the same as such and such valuation report. The plan has decided that it needs to change the retirement rates. For purposes of the baseline, you will use the original assumption, the rates that were stated in the 2019 valuation. And then we have a last line here, all other assumptions, for the pre-2021 zone certification, they're just saying they're referenced in the 2019 valuation report. The plan decided that none of those assumptions need to change, and therefore in the baseline, you would also not change those assumptions. You would use the original. So you can see we really only have between template 4 and template 5 columns, the only thing that's different is the administrative expense assumption and the retirement rate assumption. That's the only difference. Template 6 is a reconciliation between template 5 and template 4. And since we have some changes, we actually are going to have a template 6. If in the prior slide, template 4 was exactly the same as template 5, everything was worked out, then you wouldn't need a template 5, and you certainly wouldn't need a template 6. But in this particular example, we're showing that you need to reconcile the differences. So not only do you summarize the different changes, you are also going to show us what the different SFA amounts that would be determined using each incremental assumption change. And the next slide does a really good job of showing that. Let's move to the next slide. Okay, so same example. This is what template 6 would have. It would have your baseline, right? There's a little table in there you have to fill out. There's instructions, and then there's the page with the table. And so this table, you're going to have your baseline showing that in template 5, the SFA amount we get using the baseline assumptions is 116.4 million. And then you're going to layer on the first assumption change. And the order is up to you. You do not have to do it in this order. You've kind of done expense assumption first and then retirement rates. But you layer on the next level, and then you come up with, hey, our SFA amount is 120.9 million. The only thing you need to do in addition is then now you have a 6-2 reconciliation details, which again is the cash flows and the present value. It looks just like template 5 and template 4 in the sense of structure. And then the last change in this particular example, we only had 2 assumption changes. You should end up at the bottom of this particular table having the same amount as the SFA you're requesting, right? In this case, the 122.9 million. And then in the notes, we have, hey, this is the same as template 4. You do not need to create another cash flow sheet. You already gave it to us in template 4. We wouldn't want you to repeat the same information. If you happen to have 4 assumption changes, the last line should always equal what you have in template 4. And you would just continue to layer on the different changes, and you would continue to tell us what the SFA amount is with the incremental changes. And then you have to make a 6-3 if there's another assumption change, showing us the cash flow and how you got the SFA amount. I hope that was helpful. We're getting there. We're very close. Take a drink of water. You got it. We're on template 7 now. Template 7 is 2 parts. And it's all about assumption changes. So we just talked about baseline. Just push baseline out of your head now. I want you to just think about your original assumptions in your pre-2021 zone certification. And then template 7 is split into 7A and 7B. 7A is all about eligibility. So you have to think, what are my assumptions that are different that made me eligible for SFA that are not the same as those used in the pre-2021 zone certification? And there's another table in there. And so what you would do is you would say, okay, I've got here's my pre-2021 assumption change or assumption. Here's my change. You're just going to summarize why the original was unreasonable and why the new one is reasonable. It's just a summary. Now, a lot of plans are not going to be required to have a template 7A. So you could just not fill it out or say not applicable when you're in the spreadsheet. But that would be because a plan is eligible already based on its original assumptions in the pre-2021 zone certification. That would include plans that have already had a MEPR suspension on or before March 11, 2021. It would include plans that have gone insolvent after December 2014, didn't terminate. Now, if your plan becomes eligible in the future based on zone certification, and that future zone certification has the exact same assumptions as the original assumptions in your pre-2021 zone certification, you do not have to fill out template 7A because there's no difference. You still use the original. Okay, so now 7B. Generally, this is required by everyone. It'll be interesting to see those plans that it's not required. So again, we're looking at assumptions. We're looking at our original assumptions in our pre-2021 zone certification compared to what assumptions are we using in template 4, our SFA calculation. What is the difference? And now I know you've already uploaded or you've already have all your rationale from section D. You've got it in the template itself. We're just looking for a summary of the change and why, what it's changed to, and why the old one was unreasonable and why the new one is reasonable. And again, it's just a summary. It's not all the details. It's just a summary. All right, you made it. This is my last slide. This is all about the contribution details. This is pretty self-explanatory. It's just really you in the SFA worksheet where we showed the columns of contributions. This is just breaking out the details behind that. So your assumed CBUs, your average contribution rate. If you have reciprocity contributions, we've seen plenty of plans that a lot of their contributions do come from reciprocity payments. Any additional rehab plan contributions that are applicable, and any other kind of contribution that's applicable. And then there's the assumption of what are your withdrawal liability payments coming into the plan, if there's any. And it would be, a list of payments being made from employers who already withdrew before the SFA measurement date. You do not have to list out who these people are or what employers they are. It's just, what are you expecting on an annual basis coming from that, that stream? And then of course, if you're assuming any future withdrawal liability payments, because between your contribution, CBU assumption, and that, you're expecting some to come in. And at the end of the columns there in the template, we want to know what the projected number of active participants at the beginning of the plan year is. And that would include new entrants. And that is it for me. I appreciate your time, and I appreciate you guys hanging in there. That was a lot.
Yes, it was. Thank you, Julie. So you've read through the interim final rule and instructions. You've listened to both of PBGC's webinars. You've identified the assumptions for your application, completed the checklist and templates, and submitted everything through the e-filing portal. What next? What sorts of communication should you expect after you submitted an application for special financial assistance? We'll talk through some of that right now. PBGC's initial confirmation of receipt after you've submitted your application will go to the plan within 2 weeks. So relatively quickly within 2 weeks of submitting your application, you should hear from us. I'm confirming receipt. And if you don't, please feel free to reach out to us for whatever reason you did not get that communication. Pending approval, so throughout that 120-day review time period, PBGC staff may reach out to you with any clarifying questions, any issues with the documents you've uploaded. Maybe something got cut off, maybe something isn't clear. So we'll get in touch with you if we have any clarifying questions, and you should be on the lookout for those communications. If necessary, the plan will be required to reach out to PBGC and let us know if any of the facts or data submitted in the application is no longer accurate. If any significant circumstances of the plan has changed since you've submitted the application, as per the interim final rule, again, as soon as possible, you will be required to notify PBGC of that change, and specifically what in the application that has been submitted is no longer accurate. By day 120, of course, PBGC will make a determination as to whether the application for special financial assistance has been approved or denied. And after the transfer of SFA funds, assuming that the application has been approved, we do expect that communications with the plan will be infrequent. They will be as needed. More than likely, the next communication would be with respect to the statement of compliance, which is due to PBGC annually after receiving special financial assistance. And more on the annual statement of compliance was covered in webinar 1 available at pbgc.gov. With respect to the actual payment of special financial assistance that a plan should expect after they've received an approval, payments will usually be made within 60 days of approval. So if you did receive approval of your application on day 120, we expect within another 60 days you would receive approval. So that would be 180 days total. The automated clearinghouse, or ACH vendor or miscellaneous payment enrollment form is required to be submitted with every complete application. This form is going to be used to enable the plan to receive an electronic transfer of funds. PBGC will use the ACH system for amounts up to $100 million and the FedWire system for amounts over $100 million. If the plan is requesting SFA in amount that is over $100 million, the filer should confirm the bank's routing number for a FedWire transfer and any other information necessary for the transfer. Really, plans should get in touch with their bank to ensure that there won't be any difficulties or obstacles with respect to a very large transfer. If a plan closes the bank account, and again, we don't recommend that you do this, but if for whatever reason you don't have a choice and you close the bank account that was listed on the form that was submitted to PBGC with your application for SFA, again, please notify us immediately of that change, and submit an updated form as soon as you can. With that, I'll hand it over to Harlan Weller.
Thank you, everybody. I'm going to give you a little bit of color on the Treasury guidance that we issued in conjunction with PBGC's interim final rule. That guidance is found in Notice 2021-38, which will be published in the Internal Revenue Bulletin, I think, next Monday. But if you've done your summer reading and you've read the statute and the regulations, you'll see that Section 15 of the PBGC's IFR provides the rules about plans that had suspensions. And we're talking about plans that were suspended, had suspension of benefits under MEPRA, and there were 18 of them so far. And there are also plans that went insolvent. I believe the count is in the 20s. I don't remember exact numbers. They became insolvent after December 2014 and haven't terminated. So the PBGC regulation says you have to follow IRS guidance to reinstate any benefits that were suspended, provide makeup payments, and you also have to issue a notice of reinstatement. That issue of notice of reinstatement is not an IRS requirement, it's a PBGC requirement that it's being worked in connection with the Department of Labor. And if you read the statute, you see that the Department of Labor, or the Secretary of Labor, is responsible for ensuring that the reinstatements are actually done. And they think that a notice element would be beneficial in that process. So the details of for the notice are in the instructions for SFA submissions, and the details will be covered at a later webinar. So let's talk about what's in the IRS notice. It covers the requirements for reinstatement, and it has some additional details. It covers the individual income tax treatment of the makeup payments. There's a recognition that the statute requires certain applications to be submitted both to Treasury and PBGC, and that seems a little bit redundant. So we've arranged with PBGC that if you are subject to that requirement to submit to Treasury, once you submit to PBGC in accordance with that e-filing system that Ross just described, they will share it with us, so you don't have to do a duplicate filing. And the notice also describes how you treat the SFA for purposes of the minimum funding requirements, but that's not the focus of today's guidance, and that will be covered at a later webinar. So let me turn to the reinstatement requirement. And reinstate meaning go back up to the original benefit level that people had prior to the suspension. And it's supposed to be effective no later than the month in which the SFA is paid. So it applies to individuals or participants or beneficiaries as of the month SFA is paid. So if someone has died in the interim, they will not actually have a reinstatement. There's nothing to reinstate, although if they have a beneficiary who has a continuation of their annuity, that beneficiary will have a reinstatement of their continued benefit. For insolvent plans, we recognize that some insolvent plans don't specifically amend their terms when they go insolvent. They may have some, maybe they thought of it as boilerplate language that just provided that if the plan is insolvent, that the benefits are reduced to the extent necessary so the benefits match the resources. And if that is the kind of language that you're going to have an explicit amendment to do a reinstatement to override that language. Or if you had done an amendment, maybe when benefits were first reduced because of insolvency, you're going to have to amend the plan to increase the benefits. The increase of benefits for the insolvent plan is just for the plan year in which the SFA is paid. In subsequent plan years, you apply the regular insolvency rules. Well, you have this big block of money has come in, so you'll have more assets, so you shouldn't be insolvent, but you don't have any special rules. You apply the regular rules for insolvency in the subsequent years. Now, the considerations for MEPRA plans are a little bit different, and I want to cover those on the next slide. The first item I want to mention is that there are some MEPRA plans which had an amendment which not only did the MEPRA suspension, but also made some other changes that were not necessarily through the MEPRA process. Maybe they removed some non-411D6 protected benefits at the same time, just as a package. The reinstatement requirement is to the entire MEPRA amendment. So even if they could have been done outside of the MEPRA context, if that's the form that the plan sponsor chose to have a single amendment with MEPRA suspensions and other things, that entire amendment gets reversed. Now, MEPRA plan sponsors have an opportunity to reinstate benefits for participants in pay status before receiving SFA, not after receiving it, not just after receiving SFA. If you look at the statute and the regulations for MEPRA suspensions, there is a provision, and it's cited in this PowerPoint presentation, that a plan sponsor can amend the plan to essentially reverse some or all of the MEPRA suspensions for people who are in pay status as of the time of the amendment, subject to an equitability test. And that amendment, it increases liabilities, but it's not subject to the normal restrictions on benefit improvements for plans in critical status. It is essentially free and clear as long as you satisfy this equitability test, and all you're doing is reversing the suspension on a prospective basis for the participants and beneficiaries who are in pay status. So if you do that, you do it across the board, you'll be fine in terms of the equitability test. And the PBGC regulations, which have conditions that concern benefit increases after July 9th and before the application for SFA, that this kind of reinstatement is actually carved out. So PBGC doesn't think this is abusive if you increase the liabilities through this kind of amendment. That's because you're going to have to increase those liabilities to reverse the MEPRA suspension even after you get the SFA. So doing it early rather than later is not abusive. So you feel free to go ahead and do that. So let me turn to the makeup payments. The plans must pay a makeup payment to anyone who did not receive benefits because of the prior suspension. And the makeup payments are equal to the total amount of benefits that were not paid to an individual due to the suspension. It's just plain old add the numbers up through the adding machine, no actuarial adjustments for past payment, for interest or anything like that. And the makeup payments are for an individual. So if you have a participant who's still alive, the total amount of benefits that the participant didn't receive because of the suspension. If the participant died and they have a beneficiary, the beneficiary gets the total amount of benefits that the beneficiary lost because of the suspension, but the beneficiary does not get the benefits that the participant lost because of the suspension if the participant died after the suspension and before the SFA is paid. So that's the total amount of the makeup payments. And we turn to the next slide. The form of the makeup payments can be either a lump sum or monthly installments for over 5 years. And it's at the discretion of the plan sponsor how they want to do that payment. If it is a lump sum, the timing is it has to be made within 3 months of the date the SFA is paid. If it's installments over 5 years or 60 months, they must start within 3 months of the date the SFA is paid. And the installments are, again, very simplistic calculation. You take the total amount of missed payments and divide by 60. So there's no adjustment for interest, and those installments are paid even if the individual who's supposed to receive those payments dies before the end of the 5-year period. It is a classic installment kind of calculation. The notice does address the individual income tax rules related to the makeup payments, and in particular, the question of whether they are eligible rollover distributions. And if they are the installment payments, they are not eligible rollover distributions. They'll just be included in income as they are paid. It is also the same treatment applies to small lump sums. So the definition of a small lump sum is one that is less than or equal to the greater of 10% of the annual rate of payment, or 750. And so if that's the size of the lump sum, then it is also not an eligible rollover distribution. By contrast, if you have a lump sum payment that exceeds the greater of 10% of the annual rate of the annual payment, or 750, whichever is larger, they are eligible rollover distributions, and you have to follow all the rules for eligible rollover distributions, such as providing the participant with an election right under 401A31 for direct rollover, have to provide them a notice, and you apply 20% withholding if it's not directly rolled over. I believe that covers my discussion here, and I will turn it back over to Ross.
Thank you, Harlan. And thank you all for tuning in. I hope you found this information helpful and informative. Before we wrap up, I want to give you our SFA web address one more time. That is at pbgc.gov/ARP-SFA. You can also sign up for email updates specific to PBGC's implementation of the SFA program on this page. If you have questions, please send an email to multiemployerprogram@pbgc.gov. If you wish to submit comments, suggestions, and views on the interim rule, you can send an email to reg.comments@pbgc.gov or visit regulations.gov. If you have a media inquiry, you can direct those to our public affairs office at PBGC External Affairs @pbgc.gov or call 202-229-4343. As a reminder, ADA compliant recordings of this webinar will be posted on PBGC's website. Thank you again for your time and attention. This concludes today's meeting. Have a great day.